Welcome back, everyone, to Strat. Today we have a very special guest, the foundation of this entire strategy, and one of the experts in this space, if not the expert in this space, Thomas Castelli. Thank you for being here. If you don't mind giving a 60-second intro of who you are and what you do.
Yeah, absolutely, Ryan. Thanks for having me. It's an honor to be here today. So my name is Thomas Castelli. I'm a partner at Hall CPA, which is a national accounting firm that works with real estate investors across the United States. One of the main things about Hall CPA is that every single one of our clients is involved in real estate in some way, shape, or form. And short-term rentals is what we consider like our bread and butter. We do this on a daily basis. I don't think there's anybody probably anybody in the accounting space who's probably went deeper on this than our firm has. We've helped defend several audits in the short-term rental space, and including those from some of our major competitors. So really phenomenal place to be at Hall CPA. We do a bunch of things. My role, I came up as a tax strategist throughout the years I was with the firm, and I kind of eventually built myself up to where I'm at now, which is like, a partner here at the firm. But really, that's what it is, a high level. I'm also an investor myself. I primarily invest in limited partnership interests just because I have a lot of responsibilities here at the accounting firm that keep me occupied. But anyway, that's kind of a 60-second overview here.
Yeah. Awesome, man. And yeah, really simply, like trying to understand, of course, short-term rentals have plenty of benefits, the cash flow, the potential appreciation, depending on the market you buy in. It could be a lifestyle asset, but then there's this huge tax advantage that people talk about a lot. Could you give just a general overview of what that is?
Yeah, so I'm going to start with just a brief history. I'll try to keep it short, but I think it really lays the foundation for how where this strategy fits in. So way back in the Tax Reform Act of 1986, the Congress, they introduced what's known as the passive activity loss limits, or Section 469 of the tax code. And what that did is it said that all business activities are either going to be considered passive or non-passive. And the passive, under the passive buckets are going to be businesses in which you're not materially participating in. And then also any rental activity is also considered passive by default, regardless of how active you are. And we'll unpack why this is all important as we go here. But that was introduced, and that was introduced specifically to curb high income earners, like physicians and lawyers were like specifically named, who were basically buying up rental properties and other tax shelters, as they called it, using depreciation and other expenses to offset their W-2 or their active business income and save substantial money in taxes. So this entire section was put in to block people from buying rental properties and offsetting their active income, if you will. We fast forward a little bit to 1994, and they introduced the real estate professional status, or REPS, as they call it. And that was introduced after much lobbying by the real estate industry. The sentiment was, why could a doctor, for example, they're running a medical practice, why can they deduct their x-ray machine against their income, but I can't deduct as like a real professional, maybe I'm an agent, broker, developer, fixer, flipper, property manager, so on and so forth. Why can't I deduct this against my income? The rental losses against my income. So he said, okay, well, if you're a real estate professional who spend more than 750 hours and more than 50% of your total working time in a real property trade or business, then you can go ahead and offset your rental income. Now, so that's like for mostly long-term, mid-term rentals, things like that. Now, obviously, spending more than 50% of your total working time in a real property trade or business, if you have a full-time job or you're running a business full-time, it's not a real estate business, can be pretty challenging. So there's actually a carve out underneath this section that said if you had a property with an average period of customer use of 7 days or less, or 30 days or less, and you're providing quote unquote substantial services, then it's not considered a rental activity. Instead, it's categorized as regular business, and you do not need to spend more than 750 hours and more than 50% of your total working time. And now this was originally meant for hotels, motels. Back in the 80s and 90s when these rules were introduced, they didn't have the internet and Airbnb the way it is today. But basically, short-term rentals fall under this rule. And basically, if you have a property with an average period of customer use of 7 days or less, which is the more popular exception, then all you have to do is materially participate, which means there's 7 tests, but the one that's most popular is spending more than 100 hours and no one else spending more time than you. So you meet those 2 requirements, and all of a sudden you could take the losses from your short-term rental against your W-2 or against your business income. And that's what makes this so powerful from a tax strategy perspective, is you could still invest in real estate, get the benefits of investing in real estate, but then take the losses against your active income and significantly reduce your tax liability. That is what this strategy is about in a nutshell.
Yeah, and so much in there. So we'll kind of unpack that layer by layer. So like you mentioned rep status, like for most people coming through this program, they're likely a doctor, a lawyer, a tech sales professional making a high income. So what you're saying is essentially they can still qualify for this right or this tax advantage to their active income based off the strategy, whereas before or otherwise they might have to be a real estate professional in order to get these tax advantages.
Exactly.
Okay. And then giving a sense of like numbers, like what is the real math behind this? Like if someone just closed on $1 million property and they're self-managing and they're starting to track their hours, like walk us through what happens on their tax return in year one with a cost seg and with bonus depreciation, what that might look like.
Okay, on $1 million property, so the first thing that's going to happen on any property, we're going to have to figure out what the land value is, because the land is never depreciated, so we can't take that into account when dealing with bonus depreciation. So it depends on where you're purchasing the property, what the land value is, but for the sake of this example, we'll assume that 80% of the purchase price is the building value. So that means that 80% is depreciation eligible. Now, when you do a cost segregation study, someone's going to break that $800,000 typically is depreciated over 39 years for commercial property, which is what short-term rentals are considered. Now, that $800,000 though can be broken down into different components that have a shorter class life. That's 5-year property, that's tangible personal property, things like appliances, carpeting, fixtures, things of that nature. And then there's something called land improvements, which is 15-year property, landscaping, pools, decks, sheds, things of that nature. Those can be depreciated over 5 and 15 years, which is accelerated. However, they're also eligible for bonus depreciation. So the cost segregation study is ultimately going to be the ultimate determinator of how that breakdown looks on any specific property, but somewhere between 20 to 30% of that property could be broken down and eligible for bonus depreciation. So if we split that down the middle on this $800,000 building value here, we're looking at taking out of the $800,000, we're looking at taking roughly a deduction of $200,000, which is significant in the first year. And depending on what tax bracket you're in is going to determine how much of a value that is to you in terms of tax savings. But that is pretty much what that looks like in a year one property.
Yeah, which is very, very significant if done right. So you also mentioned the material participation, and you mentioned the common rule of thumb is that 100-hour rule, but there's multiple rules. Like, how do you advise your clients around material participation, what they need to be doing? Because a lot of these people are active workers, they have their full-time job, and they're not necessarily looking to be short-term rental operators, but like, what does it actually look like to qualify for material participation from a tax perspective?
Yeah, so material participation, there's 7 tests, but 3 of them are typically going to be the most relevant. First one's going to be you spend more than 500 hours. If you spend more than 500 hours of material participation, I'll break down what counts and doesn't count. But if you spend more than 500 hours, it does not matter how much time anybody else spent. You could check that box. You've materially participated. Most short-term rentals, challenging to get there, at least from what I've seen. The next one is you do substantially everything yourself. And what I mean by that, you're a one-person show and you pretty much have little to no outside help. The third one is you spend more than 100 hours and no one else spends more time than you. And the reason why this one's the most popular is because you can be the property manager effectively, but you can rope in cleaners, you can rope in repair people, and here and there, as long as they're not spending more time than you, you're good to go. Now, in terms of what hours count or don't count there, typically for short-term rental, hours that are going to count are going to be managing guest communication, managing pricing, coordinating the repairs and maintenance, coordinating with the cleaners, doing repairs or maintenance yourself, things like that. A good litmus test to this is, does it impact the operations of the property, right? But those are just some common things you'd see in a short-term rental that would count towards material participation.
And I'm sure you've also seen all sorts of different hours tracked, and maybe what doesn't count. Is there a common, task or time study that you see that maybe you'd advise investors against?
Yeah, for example, education is probably one of the biggest ones. So education time typically does not count as material participation. So listening to podcasts or attending educational seminars typically don't count. Also, research typically doesn't count either. The IRS hates the research thing because you could just go on the MLS and browse around. That typically is also frowned upon. So those are just a few things that that jump out automatically as stuff that people should avoid. When it comes to material participation.
Yeah. And on that same line, when do people start tracking their hours, and like, what are the tools and softwares that you'd recommend for them to do that as accurately as possible to make it easier on you guys?
Yeah. So the best time to start tracking the hours is going to be for sure after you acquire the property. We'd also advise to track your hours after you get the property under contract, just in case there's a case to be made that sometimes those hours may account. But you definitely, when I would say start tracking once you get the property under contract. And almost most certainly once you start operating the property and once you actually acquire the property, for sure at that point. That's typically when you want to do it. As for tools, there's no right or wrong answer. Usually a time log is going to be the best form of evidence. Now you can use a spreadsheet for that. It can be very simple. There are also time tracking applications out there like Clockify or Toggle. These are just generic time tracking tools that you could use. We also have a tool on our website, therealestatecpa.com, which has a tool where you can actually put your information in and download it as like an Excel file. But those are some tools that you could consider.
Yeah, we'll link that tool in the show notes. That's super helpful. And then entity structure wise, what are you recommending to clients, specifically first time or maybe second or third time short-term rental investors trying to qualify?
For entity structuring, so when it comes to entity structuring, the first thing you want to do is make sure you don't put the property in an S corporation. If anybody, an attorney or CPA or whoever, is recommending that you put your short-term rental in an S corporation, you definitely want to get a second opinion. There's a whole host of reasons why that doesn't make sense, including there's issues when you're trying to take losses out of an S corporation that can sometimes cause problems that you're not going to see in other entities, which I'll get to in a second. But also later on, if you ever do need to restructure for financing purposes, estate planning, just general asset protection, getting the property out of an S corporation triggers a sale. Even if you're just transferring it to yourself and not really selling it, now you're going to have capital gains when it's called a phantom tax because you never really sold anything. Yeah. So in general, you want to avoid an S corporation. Entity structures that typically make sense are going to be a partnership if you're going to have a partner, whether it's a third party partner or you or your spouse. Typically, a partnership is you're going to be good over there, or a single member LLC that's disregarded for tax purposes. That's typically what you want to do. Now, as people kind of advance in their real estate career, you might want to consider a holding company. So you have a holding company, and that holding company is typically a partnership or single member LLC. And then you have subsidiary LLCs that all are single member LLCs that roll up to the holding company. That is also appropriate. But again, I can't say this enough. Avoid an S corporation. If somebody does recommend that to you, maybe there's some use cases where it might make sense, but definitely get a second opinion before you move forward because that can cause a lot of damage down the line. Yeah, I would definitely recommend if you are setting up entity structures, definitely having CPAs cannot set up the entity structure for you because it's an unauthorized practice of law. So the attorney would have to do it. I would not recommend doing it yourself simply because, there's when it comes to legal stuff, again, I'm not an attorney, but the devil is always in the details and technicalities and how everything is set up. So if you go and you set it up and you miss one technicality, you could be breaching the corporate veil and totally making the LLC a moot point. So I would recommend working with an attorney on it and looping in your CPA to make sure that everything is done from a tax perspective on the up and up.
Yeah. So just to kind of recap where we're at. So like, if you're unsure about your structure, like we're talking to an attorney, and then as we're purchasing this property, like that's probably when we want to start having conversations with the CPA to make sure we are starting to track our hours. If we're going to qualify for bonus depreciation, we need to make sure we have material participation. And there's those three main rules. Likely it's going to be the 100 hours or more than anyone else. And then they can track through maybe your guys' spreadsheet or a tool like Toggle or the other tool you mentioned, which we'll link in the show notes. How about when they are furnishing the property? So with a short-term rental, the upfront design, the amenity selection, any renovations, is there something that an investor should be thinking about as they are setting up a short-term rental, at least from a tax perspective, whether that's a write-off or strategy for furnishing these short-term rentals at the beginning?
Yeah, so I'd say the strategy for furnishing the short-term rental mainly comes down to what's going to make you the most competitive in your marketplace. You definitely want to look at that from an investment perspective, but from a tax perspective, there's a few things here. So a lot of the furnishing you're going to do, like sofas, couches, fixtures, things that, pictures, a lot of that is going to be considered 5-year property, which is eligible for 100% bonus depreciation in the first year. So you definitely want to save your receipts and invoices for all of that, so you have documentation of all those expenses or those costs, so you can use bonus depreciation on it. Same thing with a lot of land improvements, pools, decks, sheds, golf courses that you see on the properties. Whatever you're doing outside typically is going to qualify as a 15-year property, which is also eligible for bonus depreciation. So you definitely want to make sure you have records of that. We always suggest having some type of bookkeeping system. We often recommend QuickBooks Online, and no, we're not affiliated with them at all, but it just happens to be the gold standard. So some type of bookkeeping software to keep track of all this and making sure you're tracking all this is going to be pertinent when you're first, doing the initial furnishing of the property.
Right. And then I'm always curious. So you use QuickBooks Online for receipts as well and receipt tracking?
Yeah, so QuickBooks Online has a built-in receipt tracking tool
Okay.
that's built into the platform. Now, if you're not using QuickBooks Online, other accounting software may or may not have it. I can't speak for all of them, but there is another tool called Expensify. Expensify is like basically a dedicated receipt management solution, and it does integrate with a lot of different software like QuickBooks. So you could use that as well. That's an option.
Okay. So yeah, like I think my biggest thing is thinking like, how do you simplify all this? So like you're talking to the attorney, you set up the structure, you got the CPA, you have your tool to track time, you have your QuickBooks set up to track your receipts. What else? Is there anything else that a student or an investor needs to be thinking of to make sure they have their bases covered? And, again, like one of the fears or the preventions we're looking for is auditing. We want to avoid that at all costs. Anything else to be thinking about in order to avoid that after tracking your hours?
Yeah.
And doing all the right things.
Yeah. So there's limited things that can be done. Like, so at the end of the day, audit risk always exists. Audits are extremely low right now. It's less than 1%. The IRS has since lost a lot of funding, so audits have been on the downtrend. But the way you want to think about auditing an audit is you want to set yourself up to win, so that if an audit ever does come, that's an easy open and shut case for you, because you have your hours tracked, you have all your receipts tracked, you have everything documented, you have a documentation that your property has an average customer use of 7 days or less, which you could pretty much get that documentation from like an Airbnb, VRBO, so on and so forth. But you want to make sure you have all of that set up. Another thing too, another big audit red flag is the use of property managers. And there's a lot of, I don't want to say debate because it's not really what it is, but a lot of operators out there try to figure out ways to loop in property managers on their short-term rentals while still meeting the material participation requirements. And you're towing a very thin line, because the IRS is very explicit that if you have a property manager, they're assuming you're not materially participating. So if you have a property management fee on your tax return where the property is reported, it's pretty much like you're kind of waving your hand at the IRS. Hey,
check me out.
So we always recommend not using property management at least the first year that you own the property. Self-manage it. Yes, you can use cleaners. Yes, you can use repairs and maintenance people. As long as you're meeting one of the material participation tests, you're in good shape. But having a property manager, even if they're just doing a small portion of it, you're increasing your risk of audit, and then you're increasing the complexity of winning an audit whenever you're in.
Yeah, it makes sense. And I know we've seen a lot of clients as property managers ourselves strategically purchase at the end of the year to still qualify for that year and then plug us in the new year. Is that something you see frequently?
Yeah. So the requirements for the short-term rental loophole or short-term rental strategy is overall on a year-by-year basis for the most part. So the requirements are you need to have an average period of customer use of 7 days or less. So the first thing there is you need to actually have customers stay at your property. I don't know if I mentioned that yet here, but you actually need to have people stay at your property. We always recommend at least 2 times, because depending on the definition of average, it could be argued that you need 2 numbers. So always have at least 2 guest stays. We always recommend getting as many as you can in the first year to fully legitimize like the fact that you have the short-term rental. But the second year you can absolutely introduce a property manager. Because the material participation test is a year-by-year test. So year 1, you either meet the requirement or you didn't. Year 2, you either met it or you didn't. And because the bulk of the tax benefits are often obtained in year 1 through first-year bonus depreciation is the technical term for it. You're getting a lot of that benefit up front. You want to make sure that you're doing everything you can to make sure you're locking that in. But then year 2, if you have a property manager on it and it goes passive, it's not the end of the world, because you've already taken the bulk of the benefits as non-passive in the first year.
Right. Also, just kind of going back to the audit. So let's say a student comes in, they claim $80,000 in STR losses, and the IRS notices. Like, what does that process actually look like?
Yeah, so if the IRS simply sends you a notice, a tax notice is usually just a clarification of information. They either need more information or some type of clarification. The biggest mistake I see people make there is just not taking action quickly enough, right? When you receive the document from the IRS, open it up, right? Don't be scared of it. Open up, read what it says. There's usually going to be a timeline in which you need to respond. I would recommend going to your CPA and bringing that notice to them and having them walk you through that notice and letting you know what you should be responding with. Sometimes it's just a simple request for information. Hey, can you send us the the receipts for these expenses, right? Or can
Yeah.
you send us your time? Can you send us this information? And if you comply and everything's on the up and up, it can very easily go away. Where people get into trouble is when they're not responding on time. I can't tell you how many times people sent us a notice on May 12th, and oh, it's due May 15th, right? Okay, well, you know what? We now we're in trouble because you know what I mean.
Yeah.
Like, so it depends on what the notice is asking for. Is be the process, but the first thing you should do is open up the notice, bring it to your CPA, and have them help you navigate what you should do, what information you should send, what information you should not send. We've had clients or someone who did not come to us first, who sent them their entire QuickBooks Online file, which was just completely unnecessary, and
Yeah.
you're opening yourself up for scrutiny. So again, just to summarize that, IRS notice depends on what they're asking for, but the process you should follow is open it up, bring it to your CPA, and let them tell you what to do.
Yeah. Yeah. And so, yeah, let's talk about CPAs, right? So, like, I know some people think they should, file their own taxes. I think at this level, it only makes sense to work with a CPA. Can you talk about the difference between, a CPA like Hall CPA or a CPA that, your friend's cousin knows, like what's the difference between really like a retail CPA versus an STR specific CPA? And like, how would you guide people towards, choosing the right CPA based on what they're doing? And in this case, it's purchasing a short-term rental.
Yeah. So the short-term rental rules here, while if you're in this space, can seem like everybody understands them. Not all CPAs understand them. Not all CPAs are locked into real estate like this. So your typical generalist, they're gonna be doing a hodgepodge of different things, whether it's small business, maybe they dabble in a little bit of real estate, maybe they're just doing people's individual tax returns and that's it. I can't tell you how many times we've had clients or people come to us who are working with generalist CPAs, and their CPAs telling them you can't use bonus depreciation, you can't use the short-term rental strategy, yet they're just flat out telling them you can't do this, despite the fact that there's a mountain of evidence and supporting documentation from the IRS, Congress, everywhere.
Yeah.
And that's because the generalists, they don't go deep enough into any one given space to fully understand all the nuances. And when it comes to real estate, and especially Section 469, there are a lot of nuances. So you want to work with a CPA who understands these rules inside and out and can help you navigate all the do's, the don'ts, how to do things properly to maximize your tax savings, but also make sure you're minimizing audit risk. So if you're getting into short-term rentals or real estate in general, I highly encourage you to at least have conversations with CPAs who are in this space who can help give you guidance on, whether or not it makes sense to go with them versus stay with your current person, because oftentimes, and probably 95% of the time, I would say, the general CPA is not going to fully be aware of these rules to help you in some cases at all with this strategy.
Yeah. And like what should a student or someone have ready for a CPA when you start that engagement? And like, what does that engagement look like when process, timeline, pricing, what to expect of that engagement?
Yeah, absolutely. So it varies from CPA firm to CPA firm, but at Hall CPA, the majority of our clients start with a tax strategy and planning engagement, or tax advisory for short. That typically includes two phases with us. The first phase is the planning phase, which takes place within like the first 30 to 45 days of working with us, where we're going to take a look at your entire individual real estate and small business, if you're in a small business, your entire situation, and outline what strategies that you could take advantage of based on where you are today and where you're looking to go. Obviously, if you're into short-term rentals, that's going to be the first thing we make sure we have on the up and up. Make sure you're meeting all the requirements. Make sure you're not making any mistakes that could jeopardize your tax savings. Making sure you have all the records and everything you need to defend an audit if God forbid that ever comes. But also, we're going to take a look at other strategies, whether it's entity structuring, paying your children to work within your business, the Augusta rule. Sometimes people are running businesses, S corporations, which do make sense for businesses. There's a whole host of things that we're going to do within that first 45 days to make sure that you're leaving no major stone unturned and everything is buttoned up from a tax perspective. And then we're there throughout the year to support you with email support, ongoing calls, tax projections, so on and so forth, to make sure that you're continuing to stay optimized and implementing the strategies the right way. So that's what it typically looks like for us. We also do offer cost segregation and bonus cost segregation studies and tax preparation. So that's stuff we can help clients with as well. But basically, that's what it looks like for us when you get started, is that we're going to go through an extensive planning process, make sure we have everything you need to be able to maximize your tax savings, and then they'll be there to hold your hand along the way. In terms of costs or pricing, what you can expect right now for most short-term rental investors, if you're just jumping into the game, you would start off on our base tier advisory engagement. That's where like 95% of our short-term rental investors start off. That is currently $6,950 for the year. It is tax deductible. If you're coming from Ryan's group here, you're going to get a $500 discount just from coming from this group. So it'd really be $6,450 for you for the year to get that started. Tax preparation depends. Most of our short-term rental clients are around $2,100 to $2,300, but it could vary a little bit depending on the complexity of other things you have going on. And then cost segregation, our average cost segregation study on a short-term rental is coming in around $2,300.
Yeah. And just to put that in perspective, like let's say someone's making $300,000, it's a software engineer. Can you talk about like what does that tax saving actually look like? Because when you put it in that perspective and you hear, then how much it costs to work with a CPA, it's more of an investment rather than a cost at that point when you see what those numbers look like.
Yeah, absolutely. So if you had $300,000 in household income, you'd have a federal tax, you'd be at the 35% tax rate, and you would be in federal taxes, you would owe in total, just in federal taxes alone, $69,000. Now, if we go back to that $1 million property from before, if you were able to get that $200,000 deduction, you're now dropping your taxable income, just to keep things equal here, from $300,000 down to $100,000, and we're looking at your taxes going from $69,000 down to, it's going to drop down to $13,000. So you're looking at roughly a $55,000 tax savings from doing this. And the question that I always just ask people is like, you're making an investment in this property, you're spending a lot of money to get into this property. The tax benefits are certainly most of the time a consideration for you. Sometimes you want to invest in the right guidance to make sure everything is done right, to make sure you're able to capture that tax savings, and also make sure you're up on the up and up in audit. Yep. I can't tell you how many times I see people come to us that are too late in the process and have already made flaws that jeopardize the tax savings and make them not be able to use this strategy, when if they just sought the proper guidance from the beginning, that wouldn't be the case for them.
The numbers don't lie. Cool, man. Well, any final thoughts, like as we walk through the entire picture here? What are any last thoughts about someone going through this process? Maybe they're a little timid because it's their first short-term rental investment. What's something you think every STR investor should understand before they get into their first property?
Yeah, I think first and foremost, realize the short-term rental is an investment. First and foremost, I see a lot of investors sometimes get too caught up in the tax benefits, and yes, it's a very nice perk, and we just discussed that. But at the end of the day, you're investing a lot of money probably in a down payment, and then you're going to take out a loan. You want to make sure that the investment is actually going to perform for you. You don't want to get into a property that is a poor property just for the tax benefits. And we've seen people do that, and then it just hurts them later on. So always look at the short-term rental as, would I buy this short-term rental from an investment perspective if the tax benefits weren't there? That's something one of my mentors told me. It's like you have to ask yourself, would you buy this property if the tax benefits were not there? If the answer to this question is no, then it's not a good investment, and you should just probably find a different property, because the tax benefits are going to be there on the right property anyway. So that's one of the big takeaways I'd say. Look at it from an investment perspective first and foremost.
Yeah. Numbers got to work. And then that's the cherry on top at the end. Well, great. Thomas, if someone wants to work with you, what is the best next step to reach out?
Yeah, absolutely. So what you're going to want to do, I think, Ryan, you're going to have a link. So that link, you want to click that link. We will schedule a discovery call with you to learn more about your situation and identify where we can help and how we could do that. And then from there, if it all makes sense, we'd engage for services, and we begin that planning process on the tax strategy side. But you could also reach me directly at Castelli at hallcpa.com, and just let me know you came from Strat, and we'll make.
And we'll put that in the show notes as well. Thomas, thank you for your time, and we'll see you guys on the next module.